Welcome to chapter 18. We're going to go over chapter 18. The book actually does a fantastic job in talking about 18, and it's just all about ratios, how you calculate them, quick ratio, current ratio, basically every single ratio that you can come up with. A couple of things though to keep in mind. Ratio by itself has absolutely no meaning at all. You have to have something to compare that to. So we have a couple of different ways that we can do it. We can do benchmarking with other companies, other similar companies. And we can do that because if it's a publicly traded company, I can get a copy of their financial statements. So can you. Just go to their website, just do a search on the internet, and you'll find their website, right? And as you create your ratios, right? We'll talk about the current ratio. Current ratio is simply just current assets divided by current liabilities. You can do it on your company because, well, you know what your financials look like, right? Because they're your company. And on the flip side of it, you know what your competitors will look like, assuming that they're publicly traded and that we can get a copy of their financials. If they are privately traded, there's probably not a very good chance at all that we can get copies of it. It's part of it. But publicly traded, we can get copies of all their financial statements. But we have to make that comparison against something. You know, how do we know if my current ratio is 2? Is that good? Is that bad? Well, we don't know. And that's why I need a comparison against another company. The other way that I do it is really it's against myself. I look at it from year over year, month over month, day over day. And I see how my metrics are really kind of showing. It's really just it's a competitive benchmarking technique. Similar layout for key performance indicators. One thing which is part of my role in pretty much every job is to establish key performance indicators, and KPIs, as we all love them, can be any type of metric, but you have to be able to go through and measure them, calculate them pretty much every week and to a certain degree every month. KPIs really come from, really driven by Six Sigma. I'm lucky enough that my time in Coke, I was able to get my black belt in Six Sigma, so I'm pretty tickled that I have a good mixture of the other parts. But when it comes to KPIs, it's super important that, you know, it's a metric, right? But you have to measure something against that metric, and it's either time, month, year, week, something internal to us, or if I can get some other company's financials or a way to look at, you know, their structure. It has to be a comparison, right? The only way it makes any sense. Now, as you look through your financials, you know, you're going to see the current ratio, quick ratio. The more important, the current ratio is just, as we know, current assets divided by current liabilities. Quick ratio is going to be basically your current assets minus inventory, divided by current liabilities. But the quick ratio its own self doesn't really have, the current ratio its own self doesn't really have any meaning. It's a bloated number. We care more about our quick ratio. I think they also call it acid test ratio, but we'll just call it the quick ratio. Quick ratio is just basically your current assets, your cash, your short-term receivables, your AR, divided by your current liabilities. And if you notice what is missing, the top part, right, current assets, it's missing inventory. And the reason why it's missing inventory is because inventory is, although it exists on paper, it is probably one of the easiest things to manipulate for companies to manipulate, to do things with, to help overstate it. And if you really think about it, right, inventory is, I know how much I pay for inventory because, well, I know how much material or labor I have tied up in it, or if I'm buying it, I know how much cash, you know, how much it's cost because I have the invoice that I actually paid for. So I have everything I need. But when it comes to inventory, a couple of things to keep in mind is we have this concept called obsolescence. And I think we may have touched on obsolescence previously. If not, I'm sure you've talked about it in some of your other courses. Obsolescence is exactly that. It's a product that is now obsolete. I can't sell it. I just can't sell it. Or if I sold it, it would be for like $1 or $3. Think about if I found black and white TVs inside my inventory of all, you know, plasmas, LCDs. they exist, right? But if you have a choice, right, what are you going to buy? Are you going to buy a black and white TV at $500, or are you going to buy a beautiful plasma for $500? Well, the answer is we're going to buy our pretty plasma, and nobody, for the most part, are going to buy the black and white TVs. Just not. So what's going to happen, though, is that inventory is still sitting there. If we do not remove it, if we do not write off that inventory, if we don't write it off, what's going to happen, that inventory, even though it has no value, even though it's totally obsolete, even has no meaning whatsoever at all, it's still going to sit there inside your inventory. It's going to sit there in your balance sheet. So what's happening is overstating your inventory. It's saying basically your inventory is worth more than it should be. And in fact, we know that it's not, right? Because I have these items that are obsolete that should have been written off, but some companies, unscrupulous companies, will go through and they just won't write it off. They'll leave it on their balance sheet forever and forever, or until an auditor comes by and asks questions about it, some variation of that. They'll just leave it on there because they have no real incentive to write it off, because as you know in the previous chapters, if I write something off, it's going to be it's an expense, right? It's exactly what it is. It's a debit to a loss on inventory, and I'm going to credit inventory. This loss is going to be an expense. It's a bad guy, right? We don't like bad guys. So that's why, for the most part, we always exclude inventory, because it's manipulated. I've got items which are obsolete. I can have items which are overstated. I can go back through, if I had an unscrupulous accounting person, I can take what inventory and I can manually key in some other numbers which will overstate inventory. It's not real. It's just a key punch to be able to bring up inventory value. Because inventory, you think about it, right? If at any one point in time, it's scattered across a whole big warehouse, and to try to track one or two things down for an auditor, right? Somebody independent, kind of a pain in the rump, and they're not going to be able to do it, or they won't do it very successfully. Inventory is excluded. But as an accountant, as a finance person, it's our job to be able to go through and put these controls in place, and that's just why that we focus more on the quick ratio as opposed to current. Because inventory can be played with, it can have obsolete numbers, it can just have all the stuff buried inside of it to make our assets look even better if they're not. It's part of it. But as accountants, as finance people, our job is to put controls in place to be able to eliminate that, or to at least mitigate it to where possible. The first thing we do is we look at an inventory aging report. And for the most part, any system you're going to have, Peachtree Accounting, QuickBooks, SAP, some old AS400, Sage Pro, whatever, for the most part, whatever financial system you have the ability to get an inventory aging report. And all that is a report that will show, here is, by straight down the line, you're going to have all your material. Over top, you're going to have 0 to 30 days, 30 to 60, 60 to 90, 90 to 120. And it's going to show the value of the inventory by month. The value by inventory by month that you have inside your physical warehouse. And what we do with that is that, you think about it, if I have inventory which is beyond 120 days, that's going to be my red flag that I have to do something with it, right? Because if it's sitting there 120 days, that means I haven't been able to sell it. So that's my flag. I have to do something. So what do? Okay, I look at cost. I look at the sales price. Maybe I'm trying to charge too much for it. It's possible. If I am, I want to get something. It is better to sell a product at a minor loss, some loss, right, than simply writing it off. It's horrible to write stuff off. So I'll cut its price down, right? I'll drop it 20% and I'll sell it. I can do that, because it's better to get some money out of the material than absolutely none at all. One thing that we've done that some companies do traditionally is they'll sell stuff, good stuff, not corrupted stuff. They'll sell it at Big Lots, and companies similar to Big Lots. Big Lots tradition will pay a retailer 50 to 60% of what we have originally asked for, like, other companies to pay. And it's a discounter, right? It's still good product. It's great product. For the most part, it's new. fantastic stuff, but because it's kind of like the overruns, right? And I'd rather get something out of it than nothing, so I'll sell it to Big Lots or some other discounter like that. They get a good deal. People who go there and they shop, they get a great deal, and pretty much everybody wins except for the company, for me, and I'm just not making as much money, but that's okay. But what I want to do is that back to inventory, so we think about inventory control. Our job is to mitigate, to really go back through and make sure that we're doing the right thing, right? That we're keeping our inventory as honest and truthful as possible. And what we'll do is that that's why we set these things up. So we look at our inventory report every day, material across by month, 0 to 30, 30, 60, anything greater than 120 days. We try to find something for. Either I try to sell it, I always try to sell it, but I'll sell it for a discount. If I may make a recommendation to the management team, if it's sitting there and I really can't sell it, nobody wants it, we may have to write it off, which always stinks, but it's part of the pain of life, right? It's always better to sell something and make a little bit of money than not have anything at all. Third part of it, of course, is that it's very much possible that as we look at we look at this inventory aging report, that I may see some dollars out there for material which would be on 120 days, but I'll go out and look for it, and it simply just won't be there. And that's what we call a cycle count. A cycle count is where you're sending a warehouse worker or yourself or whoever it may be. They go out there, they actually walk through the full warehouse, and they look for a certain material, a certain product. And they'll see, and they'll do it exactly what it says. They'll count, and that's what it is. Traditionally, that's done. We'll call it 20 items a day. Traditionally, if you do 20 items a day, you can run through your whole inventory. You'll be able to count it about 7 or 8 times in a given year, right? You're doing 20 a day, 20, 20, 20, 20, 20 a day, and you keep doing that, and you can really count everything that you have, everything, 100,000, everything you have there. Well, at least about 8 times. Sometimes it'll be more, it might be less, but in general, the number skews, it runs about 8 times. But especially when it comes to cycle counts, though, it's possible that we see dollars which are setting on the financial statements, but as we actually count, there's not. And it's just a glitch. It happens all the time. We've actually sold the material, the product to somebody, we've distributed it, it's out in somebody's hands, but for whatever reason, that information never got communicated to accounting, so, it's really not there. So if once we identify that through the cycle count, then we're going to go through and make the adjustment inside the financials. Cycle counts we do every single day. Physical inventories we'll do either every quarter, every 6 months, or once a year. And the physical inventory is exactly what it said. We shut the warehouse down. You don't produce. When you do a physical inventory, you let everybody know what's kind of going on. All the operation people are hooked into it. They do not make material. They don't manufacture anything, because what you want a snapshot. A snapshot at a point in time. Here's what's sitting in my inventory, whether it's raw materials, where it's finished goods. You need that time to actually be set, and you do 100%, 95% count of every single thing that's inside your facility. You bring the hourly associates in, whatever you need to ever how you do it. They do it 95%. As accounting people, finance people, we don't participate in that part of the count. We come back after they've counted. They say, hey, Michael, here's all the counts that we have. Here's the material, here's the counts. The first thing I will do is I'll make the comparison against, here's what they say that we have out there that they've actually counted. Here is what we have as far as what's showing in our financial statements. And if it's a significant deviation, $500 or more, $1,000, $10,000, whatever it may be, and we have another visitor in the background, over a certain dollar value, what we're going to do is that we're going to go out, we're going to send the counters out one more time, and we're going to have them double check their count. Because keep in mind, right, When people count, people make mistakes. People are human. So they'll count, they could be totally wrong on their count. And we send them back out, they correct their count, the deviation may not be there. Now what happens though, if we send them out another time, right? We send them out, they have their original count. We had a big deviation against what our financials are. I send them out a second time. They keep the count the same. At that point in time, finance, us, we will go out there and count it with them. Just to make sure, we'll walk through the warehouse, we'll make sure this is not really hidden anywhere else, because we'll want to know, because it's either going to be a true deviation. If it's a true deviation, it's a write-off, right? That's what it is. It's a loss. Just a loss on inventory. Or, you know, sometimes we walk out there and like, oh, heck, I didn't realize that. I was counting as 1, but really there's 4 in a box. So really it should be 4 as opposed to 1. Anyway, all kind of stuff that you'll find. But inventory control, we'll talk more about that in the next couple of chapters, because 19 and 20 are personal favorites of mine. Inventory control, we do that through, you know, reviewing the inventory aging schedule. We do cycle counts. What we also do is we compare material receipts. If we have a deviation on our cycle count, we do a material, well, we check the material receipts, right? Our receiving copies, what we received in from the bill of lading versus, you have that, minus what we shipped out, sold, and I know that because it's on a bill of lading that I sent to a customer, invoice to the customer. Whatever's left over should be what I'm cycle counting in the warehouse. And that's an easy, quick way for me to do. If I find deviations on the cycle count, it's a quick way for me to go back through it. But we'll talk more about that in chapter 19. But outside of that, remember, quick ratio, we love that one the best. We do that, we keep away inventory because inventory can be easily manipulated. And because people overstate it, right? Whether it's by accident, maybe they don't realize that it could be something a little bit deeper whereby they're leaving obsolete product on just to keep their inventory value up. It could be something where they're just actually just going in and manually changing numbers because, you know, you think about a big warehouse, sometimes it's really hard to find issues on it. But, you know, as far as all the other, the ratios, they make sense. You shouldn't have any problem with them. Inventory turnover ratio is really big. We want to know how quickly we turn over inventory, right? The quicker we turn it over, that means I get it, I sell it, I'm able to convert that to cash, right? Profitability. And then I'm able to go back through and then buy more inventory. But I'm still putting that profit back in my bank account and I'm paying for people right now. I'm paying their thing. Anyway, all right, chapter 19 soon. Probably in about 5 minutes. Okay, bye.